Well, hello and good evening to everyone who has joined us tonight. As always, we are excited to welcome all of you to Prosper with Us. I am Ping Mei, your host for tonight, and also the founder of ProsperUs. Tonight's session will be focusing on the world's largest stock market, the US, which has reached new highs recently. Our speaker is none other than Tim Phillips, the content composer and investment guru for ProsperUs.
Hi.
Now, just a quick introduction about myself. I have been in financial services for over 12 years and been with CGS-CIMB for over 6 years. On top of my responsibilities for ProsperUs, I am also the Group Head of Strategy and Analytics for CGS-CIMB. I was part of the original project team who started ProsperUs back in 2019, and today the ProsperUs team has grown to over 20 people. ProsperUs is part of what we call the Millennial Strategy for CGS-CIMB, and it brings the experience of CGS-CIMB, a top Singapore broker with over 40 years of heritage and history, into the new era of digital investing for the new generation of investors. Tim is the content composer for ProsperUs, but we call him our long-term investing guru. He has over 10 years of experience in financial markets, and his last stint before joining us was at the Motley Fool. Tim is an active investor and can talk about stocks for hours. His passion for investing is an asset, and he is excited to play a part in grooming the next generation of investors. I myself have personally learned so much from Tim in the past few months that we have worked together. Before we begin, let me share with you a little bit about ProsperUs. We are a new digital investment service by CGS-CIMB, the #1 broker on SGX. We are a team of passionate millennial investors who have been given this opportunity to bring you a multi-asset, multi-market investment offering to help you prosper. Our platform offers 8 types of products and covers over 30 exchanges globally. Our purpose statement is driving individuals and communities to make better investment decisions for a sustainable future. And this leads to our commitment to bring investor education to the forefront of ProsperUs and everything that we do. We are not here to encourage you to trade more, but we are here to educate and share investment knowledge and insights with you to empower you to make better decisions for yourself. Over here at ProsperUs, our key focus is on building a community of like-minded investors, which we call the ProsperUs Club. Through engagement, education, and experiences, we want to actively engage with all our clients across multiple digital and social channels. Education is key, and it is our goal to empower all of our clients with the right knowledge and investment insights. We want to help you look after your first dollar all the way until your last dollar. And finally, we want our clients to experience life with us as they grow their wealth and join us on this investing journey. For those of you who are not a ProsperUs client, I encourage you to sign up today, invest and experience life with us. We are offering commission rebates up to $880 and curated lifestyle activities for our new and active clients. And if you are already an existing client, do not worry, because you will also qualify for curated experiences if you keep investing with us. Now, here's a few examples of the curated experiences that we have for our ProsperUs Club members. For the artsy folks, you can go for a wood crafting or wheel throwing class. For the health conscious ones, you can try out flotation therapy or go for fitness classes. And for the foodies out there, you can enjoy an afternoon tea or have a martini tasting at the world famous Atlas Bar, one of Asia's top bars. So what are you waiting for? Start your investing journey with us today. Scan the QR code and follow us on Facebook, Instagram, Telegram, YouTube, LinkedIn, whichever social media channel you name it, we're on it. And to join the ProsperUs Club as a client, scan the QR code for our website. Our account opening process is purely digital and it can be completed in 10 to 15 minutes. And with that, I will now hand over the session to Tim.
Hi guys, thanks Ping for that intro. So today we're going to go through dispelling market myths in the US. So I don't want to bore you in terms of the length, so I'm going to try and keep it quite short and sweet, and then we can kind of get onto questions after that. And so, I won't keep you too long. Let me just share my screen first. So I think there are a lot of myths about the US and how we invest in the US. Obviously, you're hearing a lot of news nowadays about things hitting highs and it being expensive, et cetera, et cetera. And there are other issues around the US market and the stock market that I think I wanted to address quickly. So I'm just going to go through 3 quick myths here. And first off, the disclaimer, the usual, this is not personalized financial advice. This is my own personal opinion. So, take it with a grain of salt, so to speak. So I'm going to keep it real, right? So why do we invest in US stocks? First off, I think we need to just reestablish that. I established that a few weeks ago and went through that in detail. So first off, it's huge, massive opportunity, $45 trillion market. So that's the amount, the total value of all the shares in the US. And if you think about the second biggest market of being sort of China / Hong Kong, sort of in the mid-teens trillions, it's small compared to the US, but it's growing. But the US has always been that, has been the leader. Number 2, it's easy access. So it's always something that you can buy one share of. You can buy you can buy one share if you want to, and you can always you sort of easily access the market via ETFs or other forms. Whereas with Hong Kong or Singapore, you have to actually buy lots in sort of 100 or 500 sometimes in Hong Kong, and lots in Hong Kong can actually, and even in Singapore, can be pretty expensive. So that's something that you have to think about. The barriers to entry are very low in the US, so that's easy for people to start out. And then finally, there's the global marketplace. None of us have been traveling, so instead, why don't we go buy global companies, all listed in the US. So you've got Asian companies, you've got European companies, you've got the big semiconductor companies in Asia listed in the US. You've got consumer goods companies in Europe listed in the US. You've got South American companies listed in the US. So the US attracts global companies. So it's not necessarily just the US. Okay, so I'm going to talk about 3 myths, right? So let me start off with the first one. So the first myth is that the US is only for growth stocks. So everyone here in Singapore, actually in Asia, some from Hong Kong. In Hong Kong, a lot of people like dividend stocks because dividend stocks are tax-free in Hong Kong. And obviously being here in Singapore, I know dividend stocks in Singapore are also tax-free. So that's definitely one reason why you want to invest, obviously, in your home market, because it is tax-free, and that's understandable. And in the US, we're also aware, I'm not sure if everyone is aware, but in the US, you have a 30% dividend withholding tax. So the US government does want your money. That's unfortunate, but I think it's fine if we think about dividends longer term. So I think the 30% tax is quite painful to stomach when you actually see it coming out of your brokerage account or whatever. When the dividend is paid, they hold back 30% of that dividend as a tax, and that goes obviously to the US government. But I think as longer term investors, if we have time horizons over, say, 10 years even, and we're not retiring within the next 10 or 15 years, we should think about the growth of a dividend. So think about it instead of this year, what the yield is. Don't think about the yield, think about the growth of the dividend. So I'm going to give you an example here with Starbucks. So everyone knows Starbucks, right? You have your morning coffee. It's been listed for over 20 years now. And it's a brand that started in Seattle in the US. And obviously you can imagine, you can see it everywhere. It's gone international. So it started paying a dividend actually only 10 years ago. And it started out a very, very low dividend per share for the whole year of 18 cents. But that dividend now is $1.68. So if you think about the average growth, so that down there, compound annual growth rate, it's a technical term, but it basically means what's the average growth per year over that period of time from 2010 to 2020. And you can see it's 25.3%. So from 18 cents, it's gone up to 168. So it's a massive, massive jump over that decade. So I think that's one thing we should keep in mind. This is a great example. This is just, one company in the US that has this kind of a growth rate in terms of its dividend over the past 10 years. Another one, which I like to kind of reference as well, because it's a really well-known brand, at least maybe in the US, maybe not so much internationally, is Home Depot, right? So Home Depot is a really well-known sort of home improvement store for professionals and also for DIY people. So people want to maybe fix up something in their home, they go to Home Depot and pick something up. And so, they've had a very successful strategy over the past 10, 15 years. And Obviously, they had a bit of a dip during the housing crisis in 2007, but they came roaring back and have done really, really well since then. And you can kind of see with their dividend per share as well in 2010, how low that was at 94 cents. And then now you're talking about $6 per year you're getting from Home Depot in quarterly dividends. So in 2020, they paid out $6 per share in dividends. And so you can see there that that growth rate is in double digits, is 20% per year. So think about that over, years and decades, and think about that rate averaging out. And obviously compare it to some of the companies here. I mean, there's some great companies here. For example, there's DBS, which is a very classic yield stock in Singapore. It's a great bank. It's paid out a dividend of 55 cents. And I'm actually going to be fair, or a bit more fair, to the Singapore companies, because a lot of them cut their dividend last year. But I'm going to do from 2009 to 2019, which is when there was the last sort of full year dividend they paid without the cap for banks that was imposed by the MAS. So they've actually grown their dividend around 8.2%. So those companies in Singapore, they all yield a bit higher, right? The dividend yield is maybe 3, 4, or 5%. So people look at that yield and they think, wow, that's really, really great. I get that. I get all that yield to myself. But if you think about the growth of the dividend over years, if you're thinking from a long-term perspective and a growth perspective of the dividend, it's actually not super compelling. I mean, it's good. It's beating inflation. So I think DBS is definitely one of the better banks here that has beaten inflation in terms of the growth of its dividend, but it's not in the same ballpark or in the same region as some of these, top US companies that are growing their dividends double-digit rates. And then we've got REITs, right? Capital Land Integrated Commercial Trust, which was formerly known as Capital Land Mall Trust, and they acquired Capital Land Commercial. So now it's a massive entity with commercial properties and retail properties. And they've actually been quite disappointing, and everyone likes to talk about them being a really great REIT. You hold it. They own Funan, they own Plaza Sing, all great retail properties. I mean, there's no arguing about that. But the business, has it been that amazing over the past 10 years for its growth? And I don't think it has been. I think it's barely sort of grown above inflation, probably matched inflation, 3.1% from 2009 to 2019, so 10 years again. So I don't think it's been that impressive, but everyone always talks about it as being a REIT they really, really love to buy. But think about that growth over years, and has that delivered the returns for you over that period of time that you want? And I think that's something that we really need to ask ourselves. So when I look at dividends, or when I look at how we invest in dividends, I think, what is your yield on the cost that you're paying, right? So if you had bought Starbucks shares back in 2010 at the cost that they were back then, in terms of the payout now, it would be paying out 12% if you had based it on the price back then. So they paid out 18 cents back then, and then they're now paying out something like sort of 168, right? I think you had bought it then, it would have been about 16 to maybe like $15, $16 or $13 in 2010. And so your yield is basically what is the yield when you had bought it if you're getting the dividend today. So when you put that money in 2010, that money now is generating 12%, right, based on the dividend that they're generating. So even if you take 30% off, I mean, this is a bit boring, but it's basic maths. If you just take 30% off 12.3%, you're still getting sort of like 9%, right? So it's still very, very good. And same with Home Depot. I mean, the yield on cost, if you had bought shares in 2010, would have been 17%. You take 30% off that in tax, that's still something like 12% or so. So it's still very, very good. And DBS, is 7.9 and 6.4 at Capital Land Commercial. So Capital Land Integrated rather. So they're actually less. They're yielding less for you based on the prices that you had paid in 2010, even after tax. So actually, the tax shouldn't really be that much of a deterrence if we're thinking beyond 5-10 years. If we're thinking, is this business going to be able to grow and continue? And do we want to be a part of that journey with this business? Because I think the US has those businesses that are global, in reach. So Starbucks, for example, is everywhere, as you know. But DBS obviously is sort of confined to Southeast Asia and maybe a bit in Hong Kong. And then Capital Lands, they have most of their properties are in Singapore. They have one, I think they have one office property in Germany. So it kind of gives you an idea of the reach of US companies and how that can then translate into dividends and sort of the cash flow over time. Okay, so myth 2, American companies are too exposed to the US economy. And the US economy is coming back after the pandemic, but it's obviously not growing at the same rate as China or maybe other Asian countries which have a faster rate of growth. But again, I'd remind you that stock market returns don't correlate at all to economic growth. So China's had amazing economic growth over the past 10, 15 years, but their stock market hasn't been nearly as hasn't returned nearly as much as the US stock market has. So it's something to think about when you do think about growth. And American companies are global. So this is something I had pointed out in the last webinar with Netflix is, it's available everywhere except basically China, North Korea, Syria, and the Crimea. So it's basically 4 regions or countries, but everywhere else it's available. So you can imagine all that revenue they're generating from a global audience. The same with PayPal, which is a digital payments firm. It's trying to turn itself into a financial super app, and they're in more than 200 markets. So I think it's cognizant, we should be remembering or be cognizant of the fact that American companies generate a lot of their revenue from overseas, not just in the US. So that's something that I think maybe we tend to forget, is that the international angle of American companies is really, really, really big. It's exciting because they tend to dominate a lot of the brands that we interact with every day. And that means revenue is international, right? So for example, this is Nike. I won't bore you the details, but I kind of circled, where revenue is coming from in their latest quarterly earnings. And, over 60% of Nike's revenue is actually from outside the US. And you can kind of see there in the vertical red circle, that's China has been growing at, crazy rates, 50, 54%. That may have had something to do with the pandemic, but you can see if other areas are maybe falling back or suffering, there's always other areas that are going to catch up for American companies. So I think the growth for the American companies, a lot of it that we don't appreciate actually comes from outside the US, because there is a lot of growth in the US, but them transporting their products or their services or what they do to outside the US, that's where the real growth and excitement can actually, and the returns can actually be generated. Okay, so finally, myth 3. The US market is really expensive, so expensive. We don't want to, I don't want to get in. It's really at an all-time high. It's hit an all-time high again this week. So what should you do? Should you put it in? Should you get into the US? I would say, things are cheap for a reason. So for example, the Singapore Straits Times Index is very, very cheap, but there are lots of old economy companies in the index, right? So you do really have to think and pick companies within Singapore to really generate that outperformance. So you can kind of see the 25-year return just on a price basis here, on an index basis, has been really poor. So, I mean, it's not as though you're accessing really high growth companies that are generating, massive amounts of return when you just buy an index. So if you did want to buy an index, that would probably be the wrong way to do it. In Singapore, you'd probably have to go out and buy individual stocks, just because the index is not reflective, I guess, of the current state of the world economy. So I tend to think things that are cheap for a reason, unless there's a very good reason that they're undervalued. But nowadays, with the markets and with the amount of information everybody has, it's likely not to be, a dislocation. It's likely that it is cheap for a very good reason. And then quality is never cheap, right? So when you buy a nice handbag or you go to a nice restaurant and you pay, it's expensive. But you expect quality when you do pay, right? You expect the goods that you've bought to be well made, to be, last long, to be well constructed. And you expect the meal that you have to taste really good and the ingredients to be really fresh, and for everything to, just be to lift that experience. So I think the same thing can be said about stocks and with markets. The quality is never cheap. So you can't ever say, I should be getting this for cheaper, even though, what goes into it and what makes up that index is of a more premium sort of value or quality. So I think we tend to think we want things cheaper when we think about stocks. but actually it's never going to be that way, because quality is, it's a rare commodity when you're talking about stocks. If you're finding good quality companies or good quality, even the index. I mean, as you can see, the S&P has, quadrupled over the past 25 years. I mean, obviously a lot of that recently has had to do with technology companies, and they're obviously very, very high quality companies, the mega cap tech companies like Microsoft and Apple and Amazon and, your Googles and Netflixes. I mean, they're the ones that are really generating massive amounts of cash and massive amounts of profit. And so that again translates into this kind of performance. So I think we should think about that when we think about the US being super, super expensive, and like, but where else is there the same sort of quality in the terms of companies that you're purchasing? Okay, so how do you approach US stocks? I just thought I'd put this into a meme just to show you. I think mainly to capture the first point about dividends. I think a lot of people think that dividends are just meant to be in Singapore because it's tax-free in Singapore, and the US is horrible because the US is, they take 30% off you, and that means you can't buy anything in the US that pays a dividend because it's completely pointless. But I'm hoping I've sort of changed your mind a little bit in this presentation, in this webinar so far. And let's let the rock do the talking, right? So I mean, a lot of these companies have paid dividends for years and years and years, if not decades. And so there is a class of companies known as dividend aristocrats, and they're companies that have paid the same stable dividend for 25 years or more. And there are lots of companies in that. And then there's also dividend kings, which I think is, sort of companies that have paid for 50 years, so something crazy. But there are plenty of companies that actually have paid rising dividends over that period of time, because they're such strong, reliable companies that pay out, every quarter, year after year, and they never cut. So I think that's one thing that you can see the US as. And that was something that happened last year with the pandemic, is a lot of companies in Europe and Asia cut dividends. But actually in the US, because a lot of companies buy back stock, they basically just stopped buying back their stock to protect their dividend. And that allowed them to continue to pay their dividend, or to actually raise it in some cases. So that's something that I think we should be, just a bit more aware of, because actually the yield is not the most important thing when you invest in a dividend. For me personally, and I think for anyone who has a bit more of a longer time horizon, the actual growth of that dividend and the sustainability of that dividend is much, much, much more important, because the yield on cost is what you want in sort of 5-10 years. Is that yield going to be good, or is it going to be kind of like average, or is it going to be below par? So I think you need to find the companies that are going to pay the growing and sustainable dividends, and don't focus so much just on the dividend yield. Okay, I think psychology of investing. I think Ping, you wanted to maybe take this and sort of share your thoughts on your own lessons. So I'll let you take this.
Thank you very much, Tim. So I'm not as experienced or successful an investor like Tim, but since I am a psychology graduate, so I thought I would attempt to share a psychology of investing lesson tonight. All right, so today's lesson is, when it comes to investing, don't be emotional. Emotional attachment is bad. When you're investing in companies, please remember you are not in a relationship with the company. So it's important to not become attached to any of the companies that you are holding in your portfolio. Even great companies are performing well can go off track. I think one such example here is General Electric. GE has been around since the 1890s and was one of the original 12 companies listed on the Dow Jones Industrial Average. In fact, in 2000, GE became the most valuable company in the world with a market cap of 601 billion. At that point, it seemed like GE could do no wrong as investors piled in. However, when the 2008 crisis hit, GE stock price fell by 42% within the year, and the GE Capital financial business was in big trouble. Since then, GE continues to struggle. It has divested a lot of businesses. It's laid off a lot of staff. At least 100,000 employees has been laid off in the last 10 years or so. And its share price has been continuously coming down, and is no longer the great company it once was. Its dividend payouts have also been slashed significantly. And finally, in 2018, after more than 100 years on the Dow Jones Industrial Average, GE was finally dropped from the index. Learning from this GE example, we must remember to base our investment decisions on fundamentals, such as long-term business performance and earnings. It's also important to note that disruption is real and no companies are immune. A company that is leading in the industry today might become irrelevant tomorrow when new entrants come in with new innovations. Does anyone still remember the BlackBerry, the leading smartphone before iPhone took over? A lot of us buy shares in companies that we like, and when the signs are there that the company is starting to struggle and its share price starts to drop, we end up holding on for all the wrong sentimental reasons. I myself had made this mistake before. Years ago, I bought some shares in a property developer in Malaysia. I really liked the houses that this developer built, and it was my dream someday to buy one of their houses. But at that point in time, I couldn't afford to buy one of their houses, so I figured, why not buy their shares instead? Within a couple of years, the share price started falling, but I held on to the shares because I kept thinking that it would turn around. After all, they built such pretty houses. But of course, in the end, I lost around 50% of the value of my investment. And until today, the company's share price has not recovered. I definitely held on for too long because of the wrong reasons. And I should have, set a stop loss position. And now I've learned my lesson, and thankfully I have not repeated this same mistake again. And with that, that's the end of our psychology of investing lesson for tonight. And I hope you have gained something useful from our session today. And now back to you, Tim. Do you have anything to add on?
Yeah, I mean, I would just pick up on the last point about companies and disruption. I think it is a really good point because many companies have scaled the heights. I mean, GE is a good example, but there's another one actually from Hong Kong, in the Hong Kong market, that I think is probably not a very well-known fact, but actually the first company to reach a $1 trillion market cap was not Apple, it was PetroChina back in 2007. It floated in Hong Kong in the early 2000s, and it also floated in Shanghai. So it was actually a massive company in 2007. And Warren Buffett was well known for having bought into it and basically sold out at the top. It topped out at just over $1 trillion in market cap. Today, I think it's lost about 80% of its value, 90% of its value. And so you can see that that's a perfect example of disruption of them kind of, you're hitting the cycle peak with oil in China, and then it coming down, and then it stayed on, and there were issues with production. And so basically it's had a really terrible time since then. And it's never recovered. And that was, 14 years ago. So you can imagine you've lost 80, 90% of your value of your investment that you bought in 2007 at the top in PetroChina. And so I think that just reminds me that it's definitely, you need to, if you're going to buy individual stocks, you need to be on top of what they're doing. Are they ahead of the game? Are they staying in? Are they disrupting? Are they being disrupted, or are they disrupting? And obviously you want to be invested in the ones that are disrupting industries and staying ahead. So yeah, I think that's all I wanted to add. I think we've wrapped up. So I think, we can kind of get to questions. That was good that we sped through that. I sped through that. That was hopefully not too long for everybody. If you do have questions, please, submit in the Q&A. I did want to plug the upcoming sessions we're doing. So next month's one was actually scheduled to be on the 20th of May, but we've had to push it back to some scheduling, due to some scheduling issues, to the 27th. So it's exactly the same time, just 1 week later on Thursday, the 27th, instead of Thursday, the 20th. And I'm going to go through how to start building, a lit portfolio, and what to do and what not to do when you start out building a portfolio, because I think a lot of people don't know how to go about starting it, to build one, or what you should do, what you should put in it. And I'll give you some ideas about what you can start with to get going. And I think there's a lot of other things that go into that whole process, such as understanding what type of investor you are, what's your risk tolerance, all those types of things. And then in June, we're going to do one on portfolio goals, whether you're into growth, whether you're into income, whether you want both. I don't think there's anything, any rules saying that you can't be a growth investor as well as a dividend investor. So you just have to pick and choose your style. Everyone is different. So I think that's the great thing about investing. There's no right answer to it. Everyone will have their own style. And we'll go through that in June as well. So please do join us for those two if you can, and if you have the time on the Thursdays at 8 the same time. Yeah, thank you. Guess we will take questions if we have questions.
Yep, I think the questions, there's a couple of questions coming in. All right, first question. You mentioned about how good companies can always go off track, but we buy certain companies stock based on their performances.
Right.
If it falls suddenly next day, how do we prepare ourselves mentally?
Well, I think volatility, I've said this a lot, volatility is very normal. So your stock won't go up every day, and it won't go down every day, but you do need to realize that it will go down because that's just the way the market works. If you're talking about buying a stock based on its performance, on its stock performance, I mean, you should not just base it or buy anything based solely on what it's done in the sort of previous 5 years or even maybe 2 months. I think just make sure you understand the business, make sure the business's prospects look bright, the business is doing well. If it does drop 5%, if it does, drop 10%, and it's for a reason that isn't really material, then I think you shouldn't worry. You need to prepare. I think I like to think, is this business going to be worth more in 5 years? If it is, then it is today. Then I'm quite happy to hold that. I mean, there are so many companies reporting earnings this week, and you've seen some reactions to company shares and things falling. I mean, that's just natural. It happens, right? If you like the company, you think it's good, you think it's going to continue to grow, I don't think that's anything to get too upset about. If it's exactly the same company it was this week as last week, I just see it as being on sale. It's cheaper than it was last week. That's how I view it. But I think the only caveat I would say is if something material changes about the business that will mean that it has much less growth, baked into the business, or something, there's a scandal or something that really materially changes the business, then I think that's something that you need to worry about. But if it's, I guess analysts getting worried about some metric and the business is doing fine, it's just, it didn't do as well as it said it would, or it didn't, meet expectations, I don't think that's anything that you need to be worried about. You just need to think beyond this next week or this next month and think, is this business going to be bigger in 5 years or in 10 years? And will it play a bigger role than it does today? Then I think you should hopefully feel more comfortable. Yeah, that's how I like to think about it.
Okay, do we have another question? The team is just pulling up. Okay. What are some good metrics or benchmarks to evaluate US companies?
Okay, so I think for US companies, there's a lot of things have changed, I think, over the past sort of decade, in terms of evaluation metrics and PEs and price to book being basically irrelevant nowadays. I mean, there's a great book called Capitalism Without Capital, which is, talking about the rise of the intangible economy and just saying, that nowadays a lot of the value that's in these tech companies is in their intellectual property, their copyright, a lot of the, software that they have, which is not sort of booked as actual capital expenditure maybe on the balance sheet. So that will have an effect on price to book. And so price to book is effectively meaningless valuing these companies. If you're valuing like an insurance company, that's fine. I think that can work, and maybe a bank. But if you're talking about these technology companies and these faster growth companies, they're not really relevant. Price to sales is probably one of the better metrics to measure technology growth companies at the moment in the US, just because that will give you an idea of the growth that they're kind of expecting. Some of these higher growth companies can go up to, I mean, you're talking about price to sales of maybe sort of 40 and 50 in the really, really expensive companies like a Zoom or maybe a Snowflake. And that can range, but usually you're talking at a reasonable valuation for a high growth company can actually be sort of a price to sales of about maybe 20 for sort of a forward sales ratio. But that needs to be a really good leader in the space, right? In the SaaS software as a service space or in the tech space. So I think price to sales is one. I think obviously revenue growth is another. That's something that everyone will look is a top line growth. Is it growing fast? I think another one that is useful to keep in mind is which I think not many people may be aware of is net retention. So this is the net retention rate is basically how many people out of the existing customers are spending. If you took away all the new customers, if you just had looked at existing customers, what's their retention in terms of how much more are they spending with this company every sort of year or quarter or month? And that should be rising, right? Or that should be over 100%. You basically want it to be over 100%. And you'll see a lot of these tech companies give that number out. So you'll get an idea of whether that's a sticky ecosystem that users want to use or clients want to use. So I'd say, those are three off the top of my head for technology: price to sales, revenue growth, just because it's the most, it's the most basic. And then finally, net retention rate, or sort of takes a look at how sticky that ecosystem is or that tech product is. Yeah.
Okay, we have one more question. This is an interesting one. What do you think brokers who do not charge commission are monies deposited with them safe? So I'm gonna take this question.
Yeah, I'll let you go with that, Ping. Go for it.
So I'll just say this, there is a saying that there is no such thing as a free lunch. Now, I'm not going to comment about other brokers' business model and how they charge or do not charge commission. I want to say this, over here at ProsperUs, we charge very, very competitive rates. And in fact, I think for US markets, we charge a flat fee of $5 per trade. So again, that's obviously very, very attractive, I think, for people who trade the US markets. On the second question, are monies deposited with them safe? Well, brokers that are regulated under MES have to abide by certain rules. For example, all the money that clients transfer to us are all kept in a trust account. And that's how we protect the investors' money. So my answer would be yes, brokers regulated by MES, definitely. We do our best to abide by the regulations to protect all of the investors. Of course, brokers in other jurisdictions, again, I can't comment on the regulations over there. I hope that answers your question. Do we have another question? Yes, I think we do. How are dividends affected by withholding tax for foreign companies listed in the US? Example, an Irish company listed in the US.
That's a good question. So actually, that will relate to the double sort of taxation treaty that whatever company, whatever country has with Singapore. So actually, for example, TSMC, which is listed in the US, actually has a double taxation treaty with Singapore. So TSMC is a Taiwanese company, obviously, which makes semiconductors. That is listed in Taiwan, but it's also listed in the US as an ADR. But that tax rate is less because they have a taxation treaty with Singapore. So I think it will effectively look at the domicile of the company, even though it's listed in the US or has a US listing. Is it domiciled somewhere else? And if it's domiciled somewhere else, does that country have a taxation treaty with Singapore for dividends? And if it does have a taxation treaty with Singapore for dividends, you are most likely going to get a lower tax rate. So in TSMC's case, as an example, that is 20% instead of 30%. It's still a tax, but obviously it's less. So you would have to go and do your research on the double taxation treaty with those particular countries. But if you're domiciled, if you as an investor are in Singapore, then you will be looking at the Singapore-Taiwan double taxation treaty, or Singapore Island, taxation treaty, or Singapore, Australia, or wherever that company that's listed in the US is domiciled. So hopefully that answers your question. Okay, dividend. Okay, so how to identify which companies are not a good buy for dividend investments. Okay, so that one is, for me, relatively straightforward. If the company is paying out way too much of their profits in dividends, which means it's not sustainable. So look at this is a ratio called the dividend payout ratio. Again, it's really straightforward maths. It's basically what is their earnings per share and what is their dividend per share. So it's basically the dividend per share as a percentage of their earnings per share. So then you'll have an understanding of what is the payout ratio, right? If you want it to be sustainable and growing, you kind of want it to be in the 40 to 60% range. If it's anything, you know, sort of in 70 to 100, I mean, you see some companies paying out more than they earn. I mean, that's ridiculous, right? So that's never going to be sustainable. And I think for ones that are growing, you kind of actually want it to be lower. You actually want them to be paying out a sort of a lower dividend as a payout ratio so that they have room for it to grow and for it to actually expand. And again, second, I'd say also look at the track record. Have they paid for a long time? Is it like up and down in terms of the dividend per share? If it's like that, if it's a wave and it's like getting cut every other year or getting cut every 3 years, I hate those companies. They're just pointless. Like, you want a company that is just doing this with their dividend. And there are so many. There are loads of companies that do that, but there are loads of companies that also do that, or just do that, just cut the dividend. So I don't like those companies. And, you know, I think the track record is so important. That's, again, relates back to the US. There are so many companies that protect their dividend at all costs, for good reason, because there are people that rely on that dividend. So I would look at the track record. I would look at the payout ratio. I would look at the sustainability of the business. Can they continue to keep cash flows? I think the cash flow is very important as well, free cash flow, because a lot of the dividends get paid out of free cash flow. So watch that metric. So yeah, watch those three.
All right, let's see. Doesn't seem like we have any more questions coming in.
Okay, cool.
That's it. That's it for tonight.
All right. Thanks, guys. Hopefully, you know, found it informative. And hopefully we'll see some of you guys, or a lot of you, next month.
Thank you so much, everyone, for joining, and big thank you, Tim, again for sharing with us tonight.
No problem. Thank you.
See all of you in another 4 weeks.
Thanks. Bye.
Have a good night, guys.
Have a good night. Bye.